All right, welcome back. Today, we are diving deep into the world of quantitative finance, exploring the incredible mathematical engineering behind a powerful idea, statistical arbitrage. And our playbook for this journey is the fantastic 151 trading strategies. So here's how we're going to tackle this. We're going to use a building blocks approach. We'll start with the most basic concept, pairs trading, and then, piece by piece, we're going to layer on more and more complexity. By the time we're done, you'll see exactly how a truly sophisticated modern quant strategy gets built right from the ground up. Okay, but before we touch a single formula, we have to get our heads around the core philosophy. Everything we're about to talk about is built on this one single idea, mean reversion. It's this belief that over time, things tend to snap back to their average. And when they stray too far, well, that's where the opportunity is. This isn't just a gut feeling, it's a cold, hard statistical bet that history is going to rhyme. So let's start at the very beginning with our foundation, Strategy 3.8. You can think of pairs trading as the hello world of statistical arbitrage. It's the simplest, most intuitive way to put that mean reversion idea into practice. The concept itself is it's beautifully simple. Imagine you've got two companies that are basically joined at the hip, say in the same industry. Historically, their stocks move together. But then, one day, one of them shoots up for some reason while the other one just sits there. That's the moment a pairs trader leans in. They see that gap, that divergence, and they make a bet that it's not going to last, that sooner or later they'll fall back in line.
And this is where the arc becomes a science, right? It's not just a hunch. It's a clear, repeatable process. First, you find your pair. Then you run the numbers to figure out which one is temporarily rich and which one is cheap. And then you pull the trigger. You short the winner, you buy the loser, and you wait for that relationship to snap back to normal.
And here is the math that makes this whole thing tick. We're not just eyeballing it. By calculating what's called the demeaned return, which is just a fancy way of saying we take a stock's return and subtract the average return of the pair. We isolate exactly how much it has over or underperformed its partner. A positive number means it's rich. A negative number means it's cheap. It's a clean, simple, mathematical signal. Now, this next part is absolutely crucial. The strategy is designed to be dollar neutral. What does that mean? It means the money you get from short selling the rich stock is immediately used to buy the cheap stock. You're not putting any new capital in. So you're not betting on the whole market going up or down. Your bet is purely on the relationship between these two stocks snapping back into place. It is pure arbitrage. Okay, so this works beautifully for a pair of stocks. It's elegant, it's logical, but modern finance is rarely that simple. What happens when you're not just looking at two stocks, but a whole group of related companies? What if you want to trade the entire tech sector this way? Well, that question takes us to the next level. And that question leads us right into our next strategy, 3.9 single cluster mean reversion. We're about to take the exact same logic we just used for a pair and scale it up to what we call a cluster. Basically, a whole family of related stocks. And this slide just lays it out so clearly. The logic is identical. With pairs trading, you compare stock A to stock B. With cluster trading, you compare stock A to the average of its entire group. So the partner isn't a single stock anymore. It's the collective performance of its whole family. It's the same idea, just bigger. And the actual rule for how you place your bets? Well, it's this beautiful, simple little formula. The dollar position you take in any given stock is just proportional to its demeaned return, how far it's straight from the group average. And that little negative sign is key. It automatically tells you, short the outperformers, buy the underperformers. The math literally tells you what to do. Okay, so we've scaled from two stocks to a whole group, but the real world is messy, right? You've got tech stocks and energy stocks and healthcare stocks all moving for different reasons. How in the world do you manage a portfolio with all of that at once without your signals getting totally tangled up? Well, this is where quants pull out a really neat tool from linear algebra called a loading matrix. Don't let the name scare you. It sounds complicated, but it's really just a giant, super organized spreadsheet. It's a systematic way to map every single stock you care about to its specific industry group or cluster. And if you look at this table, you can see exactly what I mean. It's just a map. That's all it is. Microsoft gets a 1 in the tech column, a 0 everywhere else. ExxonMobil gets a 1 in the energy column. This matrix lets a computer instantly know which family every single stock belongs to. No guesswork, So once we have every stock sorted into its little box, we run a linear regression. Now, why do we do this? The whole point is to mathematically strip out the general trend of each sector. We want to account for the fact that, say, all tech stocks went up today. What's left over, that little epsilon, the residual, is the part of a stock's move that can't be explained by its industry. That's the pure, unadulterated mispricing signal we're looking for.
Okay, things are getting pretty sophisticated, but we can still add another layer of nuance, another layer of intelligence to this model. Because up until now, we've basically been treating the signal from every stock as equally trustworthy. But we all know that's not true in the real world.
And the thinking behind this is just, it's so smart and so intuitive. We can apply a weight to each stock in our model. A really common one is to use 1 over the stock's historical variance. What does that do? It basically tells the model, hey, that stock is all over the place, it's really noisy and erratic. Let's not trust its signal as much as this other super stable and predictable stock. We're literally building our confidence level directly into the math.
So let's just take a step back for a second. We have built this incredible machine. It can identify mispriced stocks across tons of different industries, and it can even weigh those signals based on how much we trust them. But one huge, crucial question remains. How do we combine all of these different buy and sell signals into the single best possible portfolio? How do we find the optimal balance? That brings us to the end game.
And here we are. This is the capstone, the grand finale of this whole process, where all the pieces we've assembled finally come together. Strategy 3.18 uses a powerful technique called mean variance optimization to mathematically engineer the perfect portfolio from all our signals. And really, the entire goal of modern portfolio construction boils down to this: maximize this number, the Sharpe ratio. It's just your expected profit divided by your volatility. It's the ultimate report card for any strategy. It answers the question, how much bang am I getting for my buck in terms of risk? And this slide, right here, this is the very soul of modern financial engineering. We translate our goals into the language of math. We want to maximize our returns, sure, but we also want to minimize our risk, which is captured in that CIJ term, the covariance matrix. And of course, we have to stay dollar neutral. Using a mathematical tool called Lagrange multipliers, we can basically feed all of our wishes into one single function and have a computer solve for the one single perfect set of portfolio weights that satisfies all our conditions. And that's why this quote from the book just nails it. This constructs a dollar-neutral portfolio with risk management built in. With this kind of optimization, risk isn't an afterthought. It's not something you bolt on at the end. It is a fundamental component of the portfolio's very design, baked right into its DNA from the start. But after all of this beautiful math, all this elegant engineering, we have to end with a word of caution, a really important question. Everything we've discussed is based on the idea that historical relationships will continue to hold. But what happens when they don't? What happens when a temporary break turns out to be permanent? That's the fundamental risk in all of this. And it's the one question that keeps every quant trader up at night.